Welcome, focused investors of the Vamos Fazer Dinheiro channel. We are jumping right into a comprehensive explainer on the massive wealth-generating opportunities unfolding right now in the Asia-Pacific and Hong Kong real estate investment trust markets. If you've been tracking the markets lately, you know we're standing at a totally fascinating crossroads. Today, we're looking strictly at the data to map out the shift from a period of pure defensive survival into a brand new phase of growth. We are bringing you a clear macro to micro playbook for 2025 and 2026. Let's get into it.
Okay, it's the multi-billion-dollar question, right? Is the real estate winter finally over? Now, we absolutely have to acknowledge the pain real estate investors have endured over the last few years. I mean, that high interest rate environment was brutal. Yield spreads were crushed and debt servicing costs just skyrocketed. But look at the data. It's telling us the cycle has fundamentally shifted. We've officially entered this 2025 rate-driven relief phase. The ice is thawing and the capital is finally starting to flow again.
So here's our game plan for today. 1. The real estate pivot. 2. Two avenues of growth. 3. Policy tailwinds and liquidity. 4. Winners in retail and data. 5. The office sector struggle. And 6. Navigating risks and next steps.
Section 1. The real estate pivot, moving from relief right into revival. This revival? It's heavily dictated by one absolutely massive macroeconomic force, and that's the shifting trajectory of global interest rates, specifically the sharp drop in short-term borrowing costs like HIBOR. You can see the stark contrast right here on the screen. Just look at those painful negative percentage changes from mid-2023, when the market was basically getting hammered, compared to this powerful year-to-date 2025 recovery across key markets like the Singapore and Hong Kong dollar regions. Sentiment is totally pivoted, mostly because the cost of capital has finally come back down to earth.
Moving on to Section 2. Two avenues of growth: organic and inorganic.
Okay, so now that we know the macro environment has flipped in our favor, how exactly are these entities actually capitalizing to generate cash for you? Well, it happens from two distinct angles. The first is organic growth. Because local rates are dropping, these funds are seeing massive interest cost savings. Take Sunlight REIT, for example. They actually dropped their funding costs down to 3.5%. That is a 16.1% savings in interest expenses. And because they aren't bleeding cash to service expensive debt anymore, they unlocked the second avenue, which is inorganic growth. They can suddenly pivot from playing defense to proactive capital recycling, making acquisitions that directly boost your distribution per unit, or DPU. It's a real game changer.
So the crucial point is, how does that cash actually make its way back to your pocket? Well, the Hong Kong market is strictly regulated by the SFC, and it's built very much with investors in mind. Get this. Legally, these entities are required to distribute a minimum of 90% of their after-tax net income as dividends. 90%. Add in a really conservative 50% maximum gearing limit, plus a mandate that 75% of their assets actually have to be income-generating, and you've got this premier, highly regulated dividend machine tailored perfectly for retail investors.
And these rules create some very tangible financial benefits. Just look at the 2025 and 2026 reporting periods here. SF REIT is delivering an absolutely massive 10.01% dividend yield. Fortune REIT, which is a multi-billion-dollar entity, by the way, is throwing off a really robust 7.07%. And even Link REIT, literally the largest in Asia, is providing a solid 6.38% yield. I mean, the numbers speak for themselves. The sheer attractive power of these entities right now is incredible.
Section 3. Policy tailwinds and liquidity. The real catalyst here.
Because you see, it's not just falling interest rates driving this revival. Regional structural and policy changes are literally pouring fresh capital into the market. The biggest catalyst is liquidity connectivity. We're talking about the inclusion of qualified REITs into the Stock Connect program. This gives onshore mainland investors expanded access to Hong Kong, massively broadening the investor base. On top of that, the Hong Kong government just completely waived the 0.1% stamp duty on unit transfers. So what does that do? It eliminates friction entirely and invites massive, massive inflows of capital. Section 4. The clear winners: retail and data. If we zoom right into the micro-level battlefields, where exactly is the smart money flowing for 2026? Well, the first clear winner is suburban retail, specifically those malls utilizing what we call the necessity shield. This means filling their spaces with essential trades. Think supermarkets, food and beverage, essential services, not high-end luxury boutiques.
Link REIT actually shifted its strategy so 60% of their Hong Kong tenants are now essential trades. Fortune REIT is sitting even higher at 70%, and that allows them to maintain a staggering 95.8% occupancy rate. Because, hey, whether the economy is up or down, people still need to buy groceries, right?
The second undeniable winner? The global data center sector. These assets are riding a massive structural growth wave. Thanks to the absolute explosion in AI adoption and digital transformation, demand for data storage is just off the charts. But at the same time, you have these really strict environmental sustainability standards and power constraints that are severely limiting new supply. This combo has created a global vacancy rate of just around 6%. That gives existing operators incredible pricing power and easily makes it a top pick for 2026.
Section 5. The office sector struggle. High vacancy and hybrid work.
Now, we've got to be impartial here. While retail and data centers are absolutely thriving, we have to look at the most challenged segment of the market right now, the prime office sector. And while the contrast is stark, while necessity retail is enjoying near full occupancy, citywide Grade A office vacancy hovered around 17.5% in 2025. The shift to hybrid work is definitely taking its toll. Look at Champion REIT's premium 3 Garden Road property, for instance. They saw passing rents actually drop as older peak market leases renewed at today's lower rates. But, it's not entirely doom and gloom. There is a 61% year-on-year jump in site inspections for premium central offices, which tells us forward visibility is slowly but surely improving.
Section 6. Navigating risks and next steps. Let's look at the hurdles ahead.
To be a truly focused investor, we have to ground our analysis in reality and look at the actual hurdles for 2026. First up, any surprise uptick in global inflation could totally cause volatility in that crucial interest rate trajectory. Second, that super rapid pace of rental increases we saw right after the pandemic, that might start to slow down. Third, we need to keep an eye on cross-border spending shifts. For example, the upcoming Johor-Singapore transit link is definitely going to divert some retail spend. And finally, offline retail is always facing relentless pressure from mainland e-commerce giants. So the takeaway here, active portfolio management is absolutely essential to navigate this uncertainty.
So, we've covered a huge amount of ground today, transitioning from the pain of rate hikes to the mechanics of organic growth, those awesome policy tailwinds, and exactly which sectors are winning and losing. The data is clear. We are transitioning into a true growth revival phase. With rates falling and yields rising, is your portfolio actually positioned for the REIT revival? Thank you so much to all the focused investors of the Dinheiro channel for joining me today. If you found this structured explainer valuable, please hit that like button, drop a comment down below, and make sure to subscribe to the channel. Also, activate that notification bell so you never miss out on our future updates. And remember, if you want to go deeper, I highly recommend that you click on the link in the description of the video and in the pinned comment. You can't miss it. Enjoy it now. So I'll leave you with this final thought. The capital is flowing again, but are you positioned to catch the wave, or are you just going to be left standing on the shore? See you next time.